Saturday, March 20th, 2021, the Max Gottlich Newsletter number 2, The Case for Gold by Max Gottlich. Relationship between gold and interest rates and US dollar. Everyone knows how gold, GLD, is the best store of value in the world because there's more that can be done with gold than any other metal in the world. In fact, gold is the definition of money. In Article 1, Section 10 of the US Constitution states that no state, open quote, no state shall enter into any treaty, alliance, or confederation, grant letters of marque and reprisal, coin money, emit bills of credit, make anything but gold and silver coin a tender in payment of debts, pass any bills of attainder, ex post facto law or law impairing the obligation of contracts, or grant any title of nobility. The Constitution says nothing at all about printing money, but Congress can set up mints and coin money. In fact, the US Mint was established in 1792 using a troy weight system, and still to this day it's used, but not as much. This enabled states to sustain solvency because the federal government forced states to accept only gold or silver, not fiat paper currency, which is essentially backed by nothing. In fact, the first ever US dollar was printed a year after the Federal Reserve Act of 1913, and shortly after the dollar became the world's reserve currency. Academia typically associates a higher price of gold at a lower interest rate, the treasury yield, and vice versa. So when the Fed raises the Fed funds rate, speculators position into risk assets or dollar-denominated assets, which of course puts upward pressure on the US dollar, which means the price of gold will fall. Historically, interest rates and gold are negatively correlated for the most part. Check the charts below. But there are certainly exceptions to this inverse relationship. This means that in order to be a gold bull, one must be a dollar bear. President Nixon abolished the gold window in 1971, which means other nations cannot redeem dollars for gold, and it eventually led to the final days of the Bretton Woods system. However, since then, the price of gold to date is up almost 3,000%. See the chart below. The exponential growth in federal debt and deficits combined with artificially low interest rates is a primary compensation to the exponential growth in the price of gold. See chart below. The debt accumulation is not stopping anytime soon. The gold narrative. Gold has been making new lower highs since the peak in August 2020. In fact, year to date, gold is the worst performing asset class relative to an outperformance in the energy sector. Of course, the recent months of underperformance in the price of gold is primarily due to a sharp rebound in nominal yields at the long end of the curve, which is driven by inflation fears and massive speculator net shorts on the long bond. Institutional net long gold future contracts are falling dramatically as well. The inflation fears are driven by expectations of a strong comeback in the US economy, with greater than 10% of the US population fully vaccinated for COVID-19. This puts pressure on additional fiscal support through a variety of large stimulus packages, with the most recent $1.9 trillion stimulus plan. The compelling question is, how can the price of gold double, triple, quadruple from these current levels? Assuming the Fed continues the same path of infinite QE, extreme dovishness, and large-scale asset purchases, the dollar as the world's reserve currency is not sustainable as a medium of exchange or a store of value. Central banks around the world are conducting aggressive monetary and fiscal policies and blowing up their balance sheets, which has enabled global equities to be over 120% of global GDP. Historically, when the debasement of the US dollar against a basket of other currencies occurs, like it has been since March 2020, the price of gold tends to outperform because of its safe haven status and the fact that it has positive price elasticity. Of course, this kind of debt-based environment supports a strong case for inflation. As the economy progressively reopens, expect the velocity of M2 money to tick higher as more dollars will be circulated into the economy, especially from the services side of the economy. Keep in mind, the velocity of money has never been lower. This, of course, puts pressure on the inflation narrative to come into fruition, and frankly, the evidence for inflation has not been stronger since about 40 years ago when interest rates were in double-digit territory. If this kind of environment becomes a reality, there will likely be a quote fear end quote phase where precious metal or industrial or agricultural commodities will see a colossal amount of inflows. The gap between how much the federal government adds to their balance sheet and the price of gold continues to diverge, which means the former and the latter needs to start converging. It would be tightening, and it would be common sense that the more likely scenario is the price of gold rises instead of the Fed tightening and selling treasury securities. David Hunter, seen on the Max Gottlich Show, a well-respected contrarian global macro strategist, has a relatively short-term price target for gold at $2,500 an ounce, subject to change, while another well-respected global macro strategist, Lynn Alden, currently suggests that gold is fairly valued. Some metrics point to gold being overvalued and other points to it being undervalued. For example, Lynn points out, open quote, the number of ounces of gold it takes to buy the median house is lower than usual, end quote. And open quote, gold is also about fairly valued versus the per capita growth of M2, especially given the real rates are still negative, end quote. Everyone has their own twist and turn in macro. The investor sentiment in gold is extremely bearish as this newsletter is written, which means if this inflation trade sincerely follows through, there may be a humongous rally in the price of gold. They have thrown in the towel for gold in anticipation that Bitcoin becomes the new digital gold. The problem is Bitcoin is backed by nothing and therefore does not store any value. The only considerable value for Bitcoin or any crypto asset pertains to the combination of a Ponzi scheme and a pyramid scheme conducted by the first group of people that generated significant wealth when one Bitcoin was priced at less than $10. When speculators understand this phony structure in Bitcoin, the bubble will pop and the price will fall even faster than it went up. Keep in mind, Bitcoin is not even legal tender, and it's likely to remain that way. Bitcoin has just a little over a decade of history, while gold has thousands of years of history. To conclude this newsletter by Daniel J. Borstein, open quote, planning for the future without a sense of history is like planting cut flowers, end quote.